Are you ready to take the first step toward building your financial future? Whether you're new to investing or looking to make a smart decision with your money, the stock market offers incredible opportunities for growth. In this video, we're diving into how to invest $10,000 strategically to maximize your returns while managing risk. We'll break down different approaches, from investing in reliable index funds like the S&P 500 to exploring growth stocks, dividend opportunities, and even robo-advisors for beginners. By the end of this video, you'll have a clear game plan tailored to your financial goals, risk tolerance, and investment timeline. So grab a pen and paper, or just take mental notes, and let's unlock the potential of your $10,000. Your journey to financial growth.
So how would I invest my first $10,000 if I were to start all over again as a complete beginner? Just to give you guys a quick update on one of my main portfolios, I recently hit a new all-time high, which is around $1.1 million. I'm actually very happy about this because the stock market has been going up. But I know a very popular question that a lot of you guys ask me is, hey Steve, if I were to start all over again, where would I allocate my money into the stock market? So in this video, I'm going to talk about the 4 different things that I would personally buy in my portfolio. Remember, this is what I'm comfortable with doing. You guys have to see what your own personal risk tolerance is, and you can use some of my strategies if you feel comfortable. First and foremost, I would put maybe around $3,000 or $4,000 of my money into the S&P 500. For those of you who don't know what the S&P 500 stands for, S&P stands for Standards and Poor's, and 500 represents the top 500 companies in the United States. If I were a beginner, I personally wouldn't pick individual companies because I personally think that it's a little bit more on the riskier side. When I first started investing, I invested in a lot of random stocks like Honda and all these other weird penny stocks. And yeah, I lost a lot of money. So I just don't wish this upon any of you guys watching this. So something that I would tell my younger self in my 20s is to just really diversify into the S&P 500. Whenever you buy one share of an S&P 500 fund, you're essentially investing in all the top 500 companies in the United States. This includes Microsoft, Google, Amazon, MasterCard, Visa, Costco, Waste Management, you name it. If you take a look at something outside your window, maybe around your room, most likely that company or brand is part of the S&P 500. You can kind of see the S&P 500 as the honor roll students or the honor roll companies where they have proven to a lot of investors that they can actually make money year over year. These are usually the companies that have been around for a long time and have weathered through a lot of economic storms. Now, personally, I invest in an ETF that tracks the S&P 500 called SPY. However, there are a lot of different alternatives out there like VOO, SPLG, IVV, and FXAIX, which is actually a mutual fund. I personally invest in SPY because yes, it does have a higher expense ratio, but I like to sell cover calls, and SPY is the most top traded ETF in the world right now, which means that liquidity and volume is the highest. It's very easy to sell cover calls against your shares. However, if you're someone who wants to just invest for the long term, you don't really want to sell cover calls, you're not very interested in doing that, then VOO, SPLG, IVV, FXAIX, these are all other great alternatives too. And also ETFs like VOO, they have a lower expense ratio compared to something like SPY. If you're someone who says, hey, SPY and VOO, each share is kind of pricey, it's around like $500 something right now, then you can even look into something like SPLG, which is a lower cost per share. You typically want to just choose one ETF that tracks the S&P 500. It's a little bit redundant if you were to buy one share of SPY, one share of VOO, and one share of IVV. Just stick with one and add on to that position. All of these ETFs are pretty much the same thing. They track the S&P 500. They're just from different companies, okay? And that's really just it. For those of you who are visual learners, this is a chart of how well the S&P 500 has done over the past several years. On average, the S&P 500 usually gives around a 7 to 12% annual return. This doesn't mean that every year it goes up 7 to 12%. Some years it could go down 20%. Other years it could even go up 20%. But in the long term, if you were to stretch out the x-axis, the S&P 500 usually gives around 7 to 12% a year. The second thing that I would invest in is something that tracks the NASDAQ 100 or technology companies. If I were younger and I had a very long time period to invest, I would most likely invest a little bit more into technology companies. However, if you guys have seen my other videos, you guys know that with technology companies, they are more volatile in the short term. So if you're someone who can't really stomach a correction, a pullback, then maybe technology companies aren't really for you. But for me, because my risk tolerance is a little bit higher, then yeah, I don't mind investing in these higher risk assets. Okay, so what is the NASDAQ 100? Again, very similar to the S&P 500. These are kind of like the top 100 technology companies in the United States. A couple of examples of ETFs that track technology companies are QQQ, and if you want to buy shares that are a little bit cheaper per share, QQQM is a good alternative. Within these technology ETFs, they typically hold a lot of these companies like Nvidia, Tesla, Meta, and even Google. And yes, there is some overlap in companies within these technology ETFs and the S&P 500. It's just that these ETFs that track these technology companies, there's a higher concentration of technology companies compared to S&P 500 funds. This right here is a chart that shows the performance of QQQ, which is the ETF that I invest in myself. Again, you don't have to choose this one. There are other alternatives out there, but I like QQQ. And again, I know a lot of you will ask me why I chose QQQ to invest in my portfolio. And again, QQQ is a higher traded ETF, has higher volume, higher liquidity, so it's easier for me to sell cover calls. But if you're a beginner and you want a share that's a little bit lower in price, QQQM is also a great alternative. The third thing that I would invest in are ETFs or stocks that pay a dividend. I know these companies and ETFs are more on the boring side because they don't grow as fast compared to technology companies, but for me, I do like getting paid dividends on a monthly or quarterly basis. SCHD is one of my favorite dividend paying ETFs. Again, you can choose whatever you're most comfortable with, but SCHD is kind of like the go-to for my portfolio. And within SCHD, there are a lot of these dividend paying companies like Pepsi, Coca-Cola, and Home Depot. Keep in mind that even though these dividend companies don't grow as much or as fast as these technology companies, they usually are the ones that can weather through a lot of storms, especially during a pullback or correction. You're going to notice that whenever there's negative news, technology companies, especially ones that don't really pay a dividend, they usually get sold off the fastest. This is compared to these boring dividend paying companies. They usually kind of hold their price. Of course, they're going to sell off too, but they hold their price a little bit better compared to these high volatile stocks. So if you're someone who likes to get paid dividends or you want a little bit more stability in your portfolio, then these dividend paying companies, assets, ETFs, these are the ones that you probably want to add into your portfolio. Within my account, this is a screenshot of what I was paid in the last payout. I got around $241 from SCHD. I have a couple of shares of Waste Management. I have this random share of Lockheed Martin that gave me $3.15. Meta pays a dividend too. I have a couple of dividends from Microsoft, Home Depot, MasterCard, Costco, and even Lowe's. The fourth thing that I would do in my portfolio is to keep my money as cash. A lot of people make fun of me for keeping cash in my account, but for me, it makes me sleep a little bit better at night. I usually like to keep cash just in case there's some sort of market pullback, correction. So this way I have a little bit of ammunition or some money to deploy. So this way I can pick up a couple of my favorite shares for a lower price. Okay, so this is for me. I usually like to keep around 5 to 10% of my entire portfolio as cash. But again, you can do whatever you want to do, whatever you feel most comfortable with. Now, if you're someone who uses Fidelity or one of these brokerages that give you a higher interest on uninvested cash, this is a good opportunity for you to also make some money just by leaving your money as cash. For my Fidelity account, for my uninvested cash, that is automatically put into a money market that currently at the time of this recording gives around 4 point something percent. I actually don't know what it was, but the last time I checked it was around 4.9%. Okay, so let's look at allocation. If I wanted something more on the balance side, I probably would put $4,000 into an S&P 500 fund. Again, for me, that would be SPY. Around $3,000 into more technology heavy ETFs like QQQ, around $2,000 into SCHD, dividend paying ETFs, assets, and then around $1,000 in cash. Now, if I were younger, then I would probably allocate a little bit more into technology companies. This is why I have around $5,000 here. And everything else is going to be, of course, going to be pushed down a little bit lower. if I were someone who wanted to focus more on income, or maybe I wanted to be a little bit more on the conservative side, I would choose option C, where I would have around $4,000 into SPY, $1,000 into QQQ, and around $4,000 into SCHD. And if I wanted to just keep everything simple, then you know what? I would probably just put everything into SPY or whatever ETF that tracks the S&P 500, right? I would put $9,000 into that and just keep some of that money, my portfolio, in cash. Remember, in the end, you want to see whatever is most comfortable for you. This is your money, so you don't want to listen to just anyone on the internet, including myself too. So see what strategies work for you that you feel most comfortable with. For those of you who want to build a high-paying dividend portfolio, I'm going to leave a video next to my head right here so you can watch it right after. If you guys found a lot of value in this video, I greatly appreciate it if you could give me a follow, a like, or even a comment down below, because it really does help me with the algorithm. Thanks everyone for supporting my channel, and I'll see you guys in the next video. Bye everyone.